Good morning. Welcome to the Brew. I'm your host, Lex. Today, we have Mr. Garrett DeSimone, head of quant at Options Metrics. And we are going to talk about rethinking the covered call strategy. I know a lot of people like the strategy. Garrett's got a little spin on it with a little different flavor. So let's get right to it on the opening bell. There's that music. I love it. It's head thumping music.
And
it ends now. Max likes to hear the music so long. Hi, Garrett. How are you? Welcome to the Brew.
Hey, Lex. How you doing?
I'm doing well. We've done one of these before a long time ago, I believe, right?
Yeah, it's good to be back. It's been
thanks for
3
coming
or 4
back.
years now. Yeah.
I know. You've gotten 3 years smarter than I have. I've gone in the dumb direction. You've gone in the smart direction.
I don't know about that.
Well, thanks for coming back. This is going to be fun. So real quick, the topic is covered call, and I know there's a little twist to it, which is awesome because our clients especially, and clients in general in the options space, they love using the covered call. Most people have a portfolio of stuff. They love generating a little income on things. Covered call seems to fit the bill well. It's easy to understand. Sounds like you may have taken this to a new level. So we're excited to hear this. I'm going to apologize in advance. I'm going to ask dumb questions so you clarify certain terms along the way, just so people get the full benefit of understanding. Is that cool?
That's cool. There are no dumb questions, Lex. So
Perfect. Only when I ask them, they're dumb. First of all, Garrett, tell us a little bit about yourself. I gave the 30,000 foot overview. Give us a little more specifics on what you've been doing with yourself lately in option metrics. Sorry.
Sure. So I am the head of quantitative research here at Option Metrics, and we are a data and analytics firm that specialize in option pricing and analytical tools for institutional as well as academic clients. So a lot of our work focuses on generating research and generating option implied indicators of, let's say, stock returns or measures of risks that our institutional and high-end clients can use.
Okay. Awesome. So do you hit the retail world at all? I mean, would a typical retail trader use your data or your quant methods and what have you? Is that a possibility? But they can use it, but you don't really sell to them. Is that safe?
That's correct. Yeah, we're mainly business to business. So our client base consists mostly of institutional level investors. Yep. We do serve about 30% of the academic world, which is where I come from, with historical data sets to perform research on. But with that being said, the strategies we discuss in our research is not only applicable to the institutional investor. It has a lot of use cases in the retail world as well.
Yeah, that's a great point. That was the point I was going to make as well. Just because it sounds institutional and kind of mathy, it's okay. Don't panic, everyone. We're going to get you to a soft landing here. You can use covered call strategies, especially something that's a little bit more involved like this one. We're going to make it easy to understand, I hope. Right, Mal?
Let's do this. I'm excited. I was excited about this one. Yeah.
Okay.
I've been watching videos of you. So.
Now she's going to try to stump the guest. I know how this goes. All right, Garrett, no further ado. Let's talk a little bit about this covered call strategy, and where you're going to introduce a term called beta. So let's just go with it, and we'll have you define beta in a second if it comes up.
By the way, I am a beta. I am not an alpha. I am purely beta. So
don't listen to her. That's not true. She's an alpha. Okay. Anyway, sorry, Garrett. Go ahead.
No problem. So an important, I guess, preface for this discussion we're going to have is really focusing on the beta exposure of a covered call strategy. And beta measures the systematic risk of security. So to give an example, if, let's say, Apple has a beta of 2, you would expect on average, if the broad market moves up 1%, Apple will move up 2%. And if it moves down 1%, Apple will move down 2%. So it's a measure of co-movement between an individual security and the broader market. And it's mainly associated with the risk of stock. So higher beta stocks are known to have higher risk and higher volatility.
Okay, got it. So are you going to target, you're going to probably get into this, I'm jumping ahead, I'm sure. Are you going to target low beta stocks or higher beta stocks, or it's just a mixed bag of both?
Yeah, it's, they each, high beta stocks and low beta stocks have unique unique characteristics. So for this research we're going to discuss is focused on the Magnificent Seven, which is comprised of some of the highest beta stocks in the S&P. So these are our high beta risky securities.
But they're like the George Clooney of stocks. It's like the Brad Pitt of stocks, right?
Okay. Yeah.
They're very sexy. These stocks have a lot of sex appeal.
They're very sexy. Okay.
They're very sexy, right? Okay. But it is, and I can touch on it a little bit later. Sometimes sexy doesn't bring you the best value. So
sure.
Good point.
Okay. All right. How do you like to proceed? You want to just get into describing it, or what would you like to do first?
Yeah, well, I think we can discuss what the basics of a covered call are.
Perfect.
Again, yeah, but it's like you mentioned earlier, Lex. The covered call has a lot of appeal to retail investors and investors looking for additional yields because of its simplicity. So at its core, you're buying the underlying security, and then you're selling a short call in order to gain that extra premium from the short call position. So the trade-off you have there is that you give up some upside potential. So if the stock exceeds that short call strike, then it gets called away. So you're capping your upside for additional yield.
Okay. So do you find that folks in the investment world, they typically have stocks anyway, right? They've got investments in their portfolio. I think we see a lot of this on our end, a lot of covered call writing against their portfolio. Is that you must see the same too? Obviously you wouldn't have done the study if you didn't, but do you see it as much on the institutional side as well?
Yeah, and again, it depends on the objective of the institution, and we were discussing internally, it's become very popular over the last few years, these prepackaged ETFs based on these overlay strategies as well. So since 2020, the popularity of options and at the retail level has grown enormously. So we see it on the institutional side, we see interest on the retail side, and it's we'll get to the discussion here, but the simplicity has kind of led to a misunderstanding of what the exposures of risk really are from this strategy.
Okay, so let's jump into that for a sec here, the risk side of it. So start with straight stock. We know what the risk is. It goes down, you lose money. Pretty simple. It's a 45-degree angle, I think, on a graph of P&L. So now when you add in this short call, we want to make sure everyone understands that you're selling a call against this long stock position. And typically it's a 1-to-1 ratio almost always. I know people play games and do ratios, but let's just stay with the basic 1-to-1 strategy. All of a sudden, you've introduced an element now. You've given yourself some downside sort of goodness, not forever, because the call only has so much premium in it, but you've capped away the upside, right? So the graph it's technically a synthetic short put is what it amounts to, right?
Yeah. So what essentially is happening is you're capturing that premium that's embedded in the short call. So you're giving yourself a little extra yields with, as you mentioned, the sacrifice of you don't get that upward potential, right? So if the stock exceeds that short call strike, your profits are capped.
Okay. Yeah. So as an example, then let's say you have a 50 strike, you're long the stock that's around 50, maybe it's a little under, maybe it's, whatever. And you sell that 50 call, right, against your stock, the XYZ stock. Above 50, you're giving, you're capping yourself out, with the premium that you've sold as part of the credit, right?
And we can discuss this a little bit later in this example. As it turns out, if you look at some of like the structured indices that cover covered calls, for example, CBOE has one where they look at selling an at the money covered call and an out of the money covered call. The at the money really does not generate a lot of extra return. So that is kind of one concept that really isn't I guess, fully explained or understood in covered call selling is when you tend to sell at the money options, you're not really getting compensated properly for losing that upside risk. The returns versus a covered call strategy, selling at the money options versus just being long stock, the trade-off isn't there when you lose all that upside.
Got it. That's interesting. Is there ever a time when the at the money is a good value? I'm assuming implied volatility being really high might change your mind a little bit, but maybe I'm wrong.
Yeah, well, this ties into some of what we're going to discuss, but the combination of a long stock and a short call is actually a low volatility trade, whether the investor knew that or not going in. And when you think about how you structure the strike you select to sell short, it actually changes your beta of the strategy. So to give you an example, selling an at the money covered call has a lower beta than selling an out of the money covered call, for the simple fact that the at the money short stock has a greater negative beta. So in these cases, some of our research shows, as we'll discuss, is it makes sense to actually sell closer to at the money when the beta risk is very high.
Beta risk is high. Okay, I'm thinking out loud here. Can you see, Molly? Do we have anything we can throw wood crackling out of my brain here? Okay, that makes sense to me. I get it. Because of negative variability or something like that. So with higher premium, you want negative beta stocks are going to move against the market, and you want that higher premium to kind of cover that when it moves against that market.
And so what we found, it's been well documented in the literature, and there's a whole industry that harness low volatility strategies. But the idea is that high beta securities tend to be overpriced relative to lower beta securities. So in a sense, when you're looking at a stock that as beta is artificially high, and you're running, let's say, a covered call strategy, it may make sense to think about what your strike selection is. So if I've got a stock that has very high beta, it may make more sense in my portfolio allocation decision to sell it closer to an at the money call, as opposed to a stock with a lower beta to sell a further out of the money covered call.
And historical performance proves that that's a safer bet.
So what we looked at in our back test is a little bit of dynamically varying, and this is the research I did with the Volo strategy team, and they're great with Jeff Corrado over there. But we ran a back test, essentially taking our Mag 7 securities, so our highest beta ones, and then taking our option metrics implied beta measure. And I can get into what the implied beta means a little bit after. But the notion is that if the stock's beta is higher than the last higher than the 50th percentile over the last year, we sell an at the money call. If the stock's beta is lower than its historical median, we sell an out of the money call. So the notion is that when beta is very high, we want to lower the overall beta of the portfolio. Okay,
so just so that's clear to the folks too, you're long the stock that has a positive beta, you're selling the call that has the negative beta because you're selling it, right? So those net out.
Exactly. Not perfectly, but you reduce you reduce the beta of the portfolio. I think from a investor perspective, we typically don't think of a covered call position as having a low beta, but it does. It tends to be a much more lower volatility strategy.
Sure, that makes sense.
What a good analogy. So if it's high beta and doing an at the money position would be like bringing in the sails on a windy day on a boat.
Exactly. Yeah. It's a nice way to reduce your overall risk.
Okay. Yeah. Got it.
She's very much into the water, just so we're clear.
Thanks, Lex.
You're welcome. Okay, cool. So, people have always asked me, how do you choose your strike? Right. And you've just kind of alluded to it a little bit. Can we deeper dive into that? Is there X percent out of the money we like to go with the lower beta type issues, or how do you pick these?
Yeah, I mean, so at first it depends whether you're trading at an index versus a single name, and they have very different characteristics. But we'll focus on the single name securities now. But typically, when you think about choosing the strike strike moneyness level is you need to think about what the objective you're trying to achieve is. And the other thing that really comes into play is these securities tend to have a call skew. So when you sell out of the money calls, you're capturing some of that overpricing in the call skew. Whereas when you're selling at the money, the vol tends to be a little lower if there is a smile. So you're not capturing that pricing or that call skew value there.
Okay, makes sense. Okay, that's good. So how far out of the money do you like to look? Did you say it and I missed it? Is it X%?
No, I mean it's very typical to pick 5%, 2.5%, and I think this for the retail investor, it's also really important to take into account what security you're trading, because depending on the listed options, some have very illiquid options. So if you're and this is always a case by case decision, but if you're selling something that's relatively has a liquid chain, your spreads might be very large. So that's something to consider as well.
Okay. And then how do you deal with indices? For instance, SPX doesn't have a natural underlying. It's a cash index. I know there's a future on it, but is there any way to make a facsimile of a covered call with something like SPX or an index like that?
Yeah, I mean, you would be involved in buying the future, right?
Okay.
So I think probably a more straightforward approach and a less capital intensive one for a retail user is probably focusing on the ETFs. And the SPY is very liquid. QQQ for the NASDAQ, very liquid as well. So those require less capital, and then you don't have to worry about handling futures and margin there.
Okay, got it. Now you mentioned the term implied beta. What is that, or are you getting to that? What does that mean exactly?
Yeah, you set me up for it, Lex.
Oh my gosh.
Yeah, perfect. So the implied beta is something that we've developed in-house at Option Metrics and one of our analytical tools. So if you were to go on typical finance site, let's say Yahoo, you get a beta estimate for securities. This estimate is very, very I don't want to say stale, but it moves very slowly. And the reason is typically we estimate beta or historical beta using a look back period. It may be a year, it may be 5 years to measure the returns, the covariance of returns between that stock and the index. So this is a very long time period and it moves very slowly. So if you're looking at Apple's beta, I think we have a chart of it, and you took a historical measure, it would move through time very slowly. What we do at Option Metrics is we're able to extract out what the option market believes beta to be in the future. So similar to how there's an implied volatility, there's an implied beta in stocks.
Okay, so do you want to look? Oh, sorry, go ahead, Garrett. I was going to say you want to look at the chart, but go ahead.
Yeah, we can bring up the chart. And
is that the 30? I think it's Meta. Is it Meta 30-day implied?
Yeah, it's Meta. Yeah, this would be the Meta implied beta chart.
Perfect. Let's bring the Meta chart. There it is. Would you look at that? Okay, what are we looking at here? Okay, I think I got it. So I see the implied. That's the jagged line, right? The implied beta.
Yeah, the implied beta is light blue, and a historical beta, which is a daily measure over the last year, which very classical way of calculating beta is the darker blue one.
Gotcha. And then describe to me again, I apologize. Now the chart's up and it makes more sense. What's the difference here? What are we computing, and why is it so varied with the implied? Tell me about that again.
Yeah, absolutely. So the historical measure, we're only taking historical returns and calculating it that way, typically through a regression. With implied beta, we look at the implied volatility of the underlying stock as well as the implied volatility of the index and the implied correlation. So we've got these option market measures. So and when you see this pattern of spikes, this is actually earnings. So we know vol runs up during earnings. We also know that during earnings, correlations increase because earnings give us some information about how other stocks perform in that sector. So what we see here is that there's much more variability to implied beta. So it's a much more useful tool than historical beta, which remains pretty flat throughout the sample. You get maybe 3 steps up, but Meta's beta goes up to 2.5 during earnings periods.
Yeah, I see that. Okay, cool. And then it looks like you're using a 30-day rolling option to compute the implied.
Yeah, so we take a measure, we take like a fixed calculation to get from our vol surface to get this fixed beta estimate out. So this would be the forward 30-day estimate of implied beta going forward.
Okay, great. So when you have this strategy on, okay, covered call strategy, especially in using the implied beta measure, is there an adjustment process? I mean, I don't mean getting adjusted like going to kindergarten. I mean, do you adjust the trade ever? Do you roll it? If it comes to the money, you still want to own the stock. Are you rolling this out like most people do in the retail world? Are you letting it, net out in an assignment? What goes on in terms of adjusting the position, both good and bad? If it goes down, it's obviously a problem, right?
Yeah. So the strategy we focus on, given that our signal is has variation in the implied beta, is weekly covered calls. So we let the stock get called away. If that's the case, we and then we reopen the position based on the measure of implied beta over the current implied beta versus the implied beta over the last year. So we touched on it a little bit, but if we see implied beta is very high relative to a long-term average, we sell an at-the-money call.
At the money. Bang it.
Bang it. Yep. So you'll see at-the-money calls being sold during these beta run-up periods.
Yep.
And then when implied beta is low, that's a signal for the strategy to let it loose. So we say, all right, raise the strike. We want more upside capture there. We want to expand the beta of the overall portfolio. And that's how we dynamically adjust our strategy.
Oh, nice. I love it. I love it. So, I got to say, I think aside from all the mathematics that go into the whole deal here, I think this is useful for a retail person as well. I really do.
Yeah. And I think, aside from the mechanics of deciding, oh, I need to adjust my strike, it's a different way of thinking about what kind of what exposures your portfolio is really taking in when you're buying a stock and selling a call.
Yeah.
So this is a low volatility trade,
sure,
but it also contains a component of your hedging beta. So
sure, got it. So you said something just a second ago, and I want to make sure I heard it right. You said something about weeklies with this stuff. So are you tagging these weekly expiries to trade this more often so you generate more income on a regular basis? Tell me about that a little bit.
Yeah, so we focus on weeklies because our implied beta measure is has variability, so it changes rather quickly, and we want to capture the changes in that. But as it turns out, a lot of the returns garnered from covered calls are from short-term expirations.
Okay.
So if you looked at two measures, two strategies, a monthly covered call strategy and a covered call strategy that rolled the weeklies, you would actually find better risk-adjusted return in the weekly strategy.
Okay.
Because that's another interesting fact too. The difference being is a weekly strategy like that requires a lot more maintenance, right? You're looking at your portfolio once a week, you're repicking your strike to roll on. But as it turns out, that option decay is much more rapid in the last week, and that leads to better returns.
Awesome. I love it.
Are there any limitations to beta calculations in high frequency trading?
So it's high frequency is interesting, almost like a totally different beast. But our view is this estimate of beta we've come up with would also be a better estimate of like your intraday beta exposure. So sort of kind of in the high frequency realm, right? Because if we looked at a historical beta, it doesn't, you saw it, it's completely flat, right? So it's not going to be much use to us if we're looking at tomorrow's beta exposure. But implied beta, on the other hand, that should have meaningful information.
Right. Okay, cool. Now I'm going to ask a tough one. You ready? All right. Paul, you ready? Buckle up.
Ready. I'm ready.
So guess what a popular retail strategy is? Okay. You're not going to believe it. Yes, you are going to believe it. The wheel. All right. So do you know that? I'm sure you know what that is. They sell a cash secured put. They being, the communist, sell a cash secured put. And then if they get assigned on it, they wheel around and sell a covered call, and we're back in the races. Are you a fan of that strategy in general, or how do you feel about that one?
Was that to me or to Molly?
Well, it's to you. It's more to you because Molly doesn't like the wheel so much. But
yeah, she's
we're gonna
like
put you on the
I
spot.
do like it. Yeah.
Did I describe that right? The right way? Do you know what I mean?
Yeah.
Okay.
No,
So what do
precisely.
you think about that strategy? That's a big retail favorite. Just so we're
It's
clear.
it's like dating without commitment. It's like that, right?
Yeah, that's right. Because you just keep selling that put. If you don't get assigned, it's like I don't have to go on the date.
Right.
Yeah, you're just kicking the can down the road. It's,
Right.
So again, I always say it really depends on what the investor's target objective is, right? And it always depends on what kind of securities you're selling or conducting this wheel strategy on.
Right.
So to start with the first component of it is you are short a put. Again, it really depends on at what strike your short put is, but typically it's out of the money puts, right? So you're collecting that premium, and then in the case that you do get that you do get exercised on, right? You now go and sell that short call. So the risk exposure is a little bit different than a covered call, and you're not garnering all the upside. But again, it really depends on what kind of security you're trading, right? And it does have the same, I think we discussed last time, the short put does have the same risk exposure as 100% long stock. So, there's this notion out there that naked puts are exceptionally dangerous, right? They're really dangerous if you don't have the cash to actually, accept if it gets exercised on you.
Right. That's a good point. So, and the cash secured part means that the trader or investor has enough money to cover that short put down to zero. So it's like buying stock. Quite frankly, the only difference is that you're getting a little bit of premium for that short put that negates the difference between that and the strike price. So you get a little bit of juice there, but otherwise they both can go to zero and you could lose your money. Right.
And I want to add, Lex, and it's been kind of important the last couple of years, which has been slept on a little bit, but the cash that you're holding should be in some sort of treasury asset, right? So now you might be earning between 4.5%, 5% on your cash, right? So the strategy exposure does change a little bit in a low interest rate environment.
Sure.
But you are collecting that risk-free return on your cash component of the cash secured put.
That's a good
So
point.
that is another factor to consider.
Yep. No, that's a good point.
And if you're, and I know you're B2B, so if you're a retail trader out there, want to know more about the wheel strategy, Rockwell Trading is a really great resource with Marcus.
That's a good one.
He's great. Yeah.
Good point. Okay, so you did a little study on the Mag 7 stocks with adjusted beta and those sort of things, right? Do we want to have a peek at that real quick?
Yeah, let's bring it up.
There it is. Oh, I love pretty colors. Yay. Okay.
Yeah, the colors are really important to me.
Okay. I love it.
I spent way too much time picking those out.
All right. I got to see what I'm going fast. I'm trying to read this quickly. Okay, weekly at the money cover, the blue. All right, go ahead. You explain it. We'll figure it out.
Yeah, so right now we look at a few different covered call strategies in our Magnificent 7 securities. So these are our big mega cap tech, some of the highest weights in the S&P, and we're comparing 4 different strategies. The 2 simplest ones are the weekly at the money covered calls, which is the blue line. So every week we take our basket of tech stocks, our basket of Mag 7s, and we sell a weekly covered call on this.
Okay.
So this trade, which is no surprise, has the lowest returns and some of the lowest volatility, right? Because we're doing that low beta. We're the lowest beta of all the strategies.
Okay.
The next strategy we look at is the 5% out of the money calls. So this is moving that strike further out, getting more upside capture, and this has the highest return of all these.
Yep.
So I mentioned it in our research paper, but building this strategy out, we are introducing a small amount of hindsight bias by selecting the Mag 7, right? Because we, at this point in time, right, sitting here in 2024, we call the Mag 7 because they've done so, the performance has been so outstanding. But if we look back to 2018, on the other hand, it wasn't the Mag 7 as we knew it. So a strategy that gives you the most upside capture is going to have the strongest returns, right? But then we're more interested in thinking about how to scale our portfolio with the implied beta. So the green looks at an implied beta measure, and the red looks at a historical beta measure. And essentially what this strategy does is, for our basket of 7 securities, we look at the long-term beta. And if the current beta is higher than the long-term beta, we sell an at the money. And if it's lower, we sell an out of the money. So if beta is high, the way to think about it is we want to reduce the overall beta of the portfolio, sell out of the money, sell at the money, and then more upside capture for lower beta.
Got it. Okay, is that in the which one was the lower beta? Was the red one? Sorry, Garrett, is that right?
So the implied beta is the green one, and the historical beta is the red one. So our implied beta beats out the historical beta, beats out the simple at the money one, and has a equivalent risk adjusted return. So we're thinking like Sharpe ratios, which tell you the trade off between return and your level of risk, matching the out of the money. So what this chart tells us is, since 2018, if an investor had adjusted their beta based on what the market's expectation was of the position, you would have done pretty well.
Nice. I love it. I love it. Okay.
I know that was a mouthful.
That's a mouthful.
Yeah.
I like it though. So how do you when you create this basket, are you simply buying the 7 stocks, or is it some adjusted value for, each stock is weighted somehow? Is it price adjusted, or
is it a dart? A dart
or
on the
is
board?
it
a dartboard?
I like the dartboard approach. That's how I traded when I traded in the day. Works very well. So
yeah. So as I mentioned, the Volos team put this together in their back tester, and for this we did just simple equal weighted. So we took our Mag 7 securities, just an equal weighted portfolio of that.
Okay, equal weighted. Wow.
Equal weighted. Yep.
Hey Mal, what's your favorite Mag 7 stock? Do you have one?
Well, you know what it is. It's Tesla. And it's I know he's hated, but I do.
I love it. I love it. So I'm a Cybertruck guy. It's so ugly, it's cute.
So I don't know if I'm bringing us off topic, but Optiometrics just integrated ChatGPT for dividend forecast data. Is that correct?
Yeah, that's correct. So we part of our team is the Woodseer dividend projection team, and they actively use ChatGPT to parse and understand dividends announcements to make adjustments to their forecasts.
And including American Depository Receipts, ADRs, which is how's beta on those? Are they do they run higher?
So it's a little bit interesting on ADRs.
And what is an ADR? What is an ADR?
So an ADR is typically something it's a foreign security that's traded in the U.S., right? Betas on those are a little bit interesting, because when we think about beta, we typically take let's say it's a broad-based index in the U.S., maybe the SPX, and we measure how it co-moves with that. But when you look at ADRs, there's another set of country risk almost, right? So if you've got an ADR that's maybe based in the UK, you got an ADR that's based in the UK, there's a totally different set of country risks, right? So that security will have a beta specific to that region, right? But then there's also the relationship with that security and the US, how the SPX moves. So typically betas on ADRs, it's based on industry, it's based on the business type, as you'd expect. Tech stocks, tech ADRs have very high betas. Your utilities, your real estates, if there are REITs, I don't know if there's REIT ADRs, but they tend to have lower betas.
So now that you're jumping into AI and you are a quant, what there's the transformers and then there's diffusion, and diffusion starts from chaos a bit. So what would be a better model for back testing and prediction?
That's a tough question. For my own personal experience, right? We like to, and maybe it doesn't fully answer your question. I don't know. Maybe I'm sidestepping it, but we like to build our models with economic intuition, right?
Yeah.
And I think one of the challenges of AI is you have a bunch of inputs, bunch of different nodes, and you get an output. And I believe the industry has come pretty far in understanding, which nodes connect to which and why we get that output, or what the weights in the underlying model are. But it's much easier to explain to a client and much more intuitive when you have an economic reason behind all of the variables you input into a model. So it's one of the I guess challenges to overcome with AI is this whole black box notion. And so our team is very focused on picking modeling variables that make economic sense and financial sense.
Got it. David Haight said that in this changing environment, that he almost feels like his group is going back to startup mode. And I'm wondering how, and I always like to ask a quant this because it is an ever-changing landscape. How will you be incorporating almost non-linear data points like satellites and consumer feedback, et cetera? And again, I'm probably the same answers, economic data and the true blue of back testing.
Yeah. So for our business model, some of these are very like Walmart parking lots are very, very alternative data, but we really like to focus on our core business, which is data, providing market data, which we know has a value. So there's a very high, typically with these alternative data sets, there's a very high bar for the end users to be willing to subscribe to them or pay for their services, because everybody has access to them now. So our focus on a company is to basically build tools that are derived from the options market that have long-lasting value. That's not necessarily like very quick, portable kind of, but long-standing information, essentially.
Got it. So what do we do with anomalous events? So what are you going to do with the upcoming elections, and how does your models get affected?
Yeah, I mean, we price volatilities and from the industry standards. So we let the market tell us what it thinks is going to happen in the election. What's been interesting is we have seen, if you look at like the VIX futures curve, you do see this very funny looking bump come October, right? So and it's very interesting. We could do a whole nother discussion on it, but this hedging that occurs during the election, right? The bump in the VIX is essentially the price of vol has increased, the price to hedge volatility across this event has increased, but this turns out to be, being short vol during this period turned out to be very profitable in 2020, and the same thing with 2016. So it's almost like this has been bid up probably a little too far, and we know, or we hope, nothing crazy happens. But,
right. Guess what, Mal?
Is it time?
Is
it tea time? Is it golf time?
It's time to have a group hug and say goodbye to Garrett for now.
Thank you, Garrett.
Thanks for coming on. This was awesome. And what I love about it too, before we go, is a lot of stuff behind the scenes, mathematically and quant driven, which I love. But it's certainly useful for both the institutional kind of person and the retail kind of person. That's what I really like about it. How can we find you? How can a customer find Garrett DeSimone? Is it optionmetrics.com or is it something else?
Yeah, it's optionmetrics.com. We have a research page, which is for everybody. So all readers are welcome to our research page.
And that's in optionmetrics.com.
That's right.
Awesome. So we will throw that in when we do this, and it'll be so much fun.
And
it's been fun.
I just want to comment that you are a quant and your educational background really comes through in your simplification and relaying an understandable viewpoint on some complicated stuff. So thank you so much.
Yeah.
Of course. Thank you.
All right. Thanks, Garrett, for coming on. We'll do it again soon sometime. Okay. Great.
Thanks,
having you.
Lex. Thanks,
All
Molly.
right.
Bye,
Have
Garrett.
a great day.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc. All rights reserved.